Back in.
Okay, I think we are live.
Hey, good morning, Robert Pease.
Good morning, Julie Harrelson. This is
How are
always
you?
we're always cautious. We're like, is the audio going to do what it needs to do? Are we going to get this echo reverb? Because even though we may appear like professional online video producers, we are really not. So
Do we have? I see we have some people registered. Are they online?
oh, I think so. Let me, they should have all been
Everybody.
pulled in now, yeah. All right, can everybody hear us? See us?
Yeah.
All those other wonderful things?
Okay.
Yeah, right on. Excellent.
Great.
Well, hey, appreciate everyone taking some time to join us. We try to do these somewhat regularly. I guess this is a monthly occurrence at this stage, and mostly kind of an open forum for your questions. We certainly try to pick a topic and kind of theme around that a little bit. That sometimes stimulates questions and good conversation. So as we get into it, if you have a question, there's a button down here at the bottom, ask a question. If you could just drop it in there. There's also this ability to vote it up. So if you like someone else's question, you can kind of give it a like or whatever, and we'll work through all of those together. Disclaimer, this is our opinion. This is not tax advice. This is not legal advice. This is not financial advice. We could very well be wrong.
Yes, we could. And we've been wrong many times.
We have indeed.
What brought us to this moment? And we wanted to talk to you about investment and seeking investment as a sales process. And part of the reason for that is that Robert and I both raised money, and we both made every mistake under the sun, which turns out is a super good basis for becoming a fund manager, because you know the pitfalls from the side of the entrepreneur, which Robert and I have a high number in the double digits of startups between us, and have both done a lot of fundraising, good, bad, and ugly. So we wanted to break that down for you this morning. I know there are a number of people online that have contacted us in the last month and said, we'd like to talk to you, we have some questions. So this is really your time. If there aren't a lot of questions, we'll end early. Robert and I can go on about a variety of subjects, but we want to make sure it's valuable to you. So that will be kind of the initial launch here in terms of our on-ramp to the discussion, is just talking a little bit about the gating factors to fundraising and some of the potential pitfalls and how to get over them or through them. But please feel free to launch all your questions, and we'll try our best to answer them or refer you to others who can answer those questions.
Absolutely. Yeah, so the whole notion here of thinking about fundraising and trying to make it a little more pragmatic, I think there's, both Julie and I kind of have personal and professional vendettas to try to demystify this a little bit, right? Because it can be ridiculously frustrating, not always transparent. We certainly do our best to be process driven, to try to be transparent, to try to be very direct when things are going to be a yes or they're going to be a no. And we are, believe it or not, constantly looking at that process to try to improve. But what I thought would be helpful, my background is kind of on the go-to-market side of things, on the operating side, building sales pipelines, lead generation, whatever. And I think fundraising is viewed through that can help clarify, right, or help sort of prioritize what you're doing. And as you think about your business and your plan, and you said, okay, I've decided I need to raise external capital, which I think is the first question, right? That's not always the place to go. Then it's about from who and how much, right? And if you think about concepts like target account selling in the sales world, right, which is just like, I know who I'm going to try to make my customer, and then begin to do a pursuit based on that. Or in the marketing world, in the last 5 years or so plus, there's been activity-based marketing, which is just literally sort of saying, I'm going to pre-qualify my targets, which I think is super important, right? And so, if you're in a particular industry, if you're at a particular stage, if you're in a particular geography, these are all things that are sort of pre-qualification criteria that you can sort pretty easily through things like Crunchbase, or you get access to PitchBook, which is kind of, it's a subscription-based thing, but there's enough data out there that you can just say, okay, for what I'm doing in my region at my stage, here's the list of suspects. And then the goal is to make those prospects, right? And that there's a variety of tactics that you can do to do that. But again, the mindset is you're trying to build a pipeline, right? Not everybody's going to convert, right, and become your customer, right, or become your investor. But I think it's a reasonable way to do it, as opposed to just, the wrong way to do this, which happens to us, is that you get basically email blasts. Like I got one yesterday from a company in Germany. Julie, do we invest in Germany?
No.
Is there anything on our website that says anything about the fact that we may invest in Germany?
No.
Right. So, again, there's the same thing happens in sales and marketing programs, right? You buy a big list, blast, you feel better about it because you emailed 1 million people, versus a little more highly targeted, highly intentional message can go a really long way. So anyway, that's my opening kind of rant / preamble to this whole thing.
Yeah, and you're talking specifically about when people are moving out of any kind of personally funded or friends and family round, right? In terms of seeking more institutional investment or angel investors that are going to support your cause and invest. And I think that oftentimes too, in those early stages where you really need some money and you don't have any kind of track record, traction, momentum yet, there are a lot of informal mistakes that can be made about raising money. Like, I once raised money from a friend, and it did not go particularly well in the final analysis, and it took some time to unwind that. But where we invest is you have some traction, you have a little bit of revenue, and you're seeking institutional funding to basically accelerate your success and reduce the amount of time it takes to get there. So, Robert, why don't you talk a little bit about how do you effectively build that pipeline? Like, what are some of the things, and maybe we can accompany this with some stories of things that we've seen in terms of people going out maybe for their first time to raise money. What's the best path from our opinionated perspective?
Yeah, look, I think that just like anything else. Okay, I want to sell something. What am I going to do? Well, you got to, again, identify who you're going to sell it to. So I think that it's worth coming up with sort of, targets and opportunities around that, and that may be direct contact, right? Again, we have a way to contact us, right? If you meet a set of criteria, right? And not all those, just like a sales process, rarely does the first conversation lead to closed, right? There's going to be multiple touches throughout the process. So, come up with who you think best fits you. And then figure out ways to contact there, right? I think, the sort of generic hello at or contact at probably is not your best thing. I think you want to try to triangulate to a person, and try to, again, you're not going to close the deal in the first conversation. I think, several of you on the line have heard me talk about this before. I think if you get conversations, it's just like, I want to share what I'm working on. I don't know if it's interesting or relevant to you, maybe, get some feedback. Don't ask, for an hour someone's time, but 30 minutes, 15 minutes, whatever it is, I think can work. And then your close is to say, hey, I put out a monthly update, right? Again, several of you have heard me say this, like friends of whatever your company name is, and just add and say, can I put you on that list? And then two things happen. One, it's your internal tracking. So on a monthly basis, you summarize what's going on with your company, customers, product, team, right? Whatever categories you want to. But also it's a nurture program, right? It's a drip program if you think about it from a marketing standpoint. And so progress can be tracked during the course of a conversation with a potential investor, or that becomes something that is easy, make sure you're okay with this. That becomes something that's easily forwardable, right? Hey, Julie, I got this really cool update from company A. Not in addition to the deck that is the currency that you use, right, to sort of get people to know, here's an operational update, because it signals that stuff's happening, right? The bus has left the station, or the train has left the station, whatever you want to say, right? And it's about how you are managing your business. It's a really rich way, I think, to communicate a lot of things. So I don't know if that directly answers your question, Julie, but I think that is that tactic, right, to sort of begin the conversations.
And let's just use Cascade Seed Fund as a startup example to this, because, we feel your pain because we're a micro fund, which means we're less than $10 million. We have to raise money every so often as well. So, Since about 2014, we've raised maybe 12 plus million bucks. And when I came to Bend, I didn't know anyone, and I was raising money. And so I quickly had to identify who the local champions were, who the local investors were, and who might make good business partners, right? Because if you're taking money on, you're taking on a business partner, and that partner is with you pretty much for the life of the business. And if something goes wrong, it's actually in some ways harder to get out of than a marriage, is what I like to say. It can be very, very complicated. So we like to suggest, when you are doing the things that Robert has said, like getting the word out, making those connections, sending your pitch deck out, that you do as much diligence on the potential investor as they're doing on you. So when we get ready, for example, to make an investment, we suggest that the entrepreneurs talk to some of the entrepreneurs in our portfolio to find out what it's like to work with us. Because every fund has different modalities, different levels of activism in terms of how involved they are in your business, different personalities in terms of the fund managers that actually, and sets of values that actually affect how those companies and those fund managers are working. And so you need to get as close to a good fit as you can at the beginning with the information that you have.
Definitely. So I'm going to go to the question board here. Got a couple of questions from Taylor. Thanks. Good to I guess see you. I don't know if we see you. I guess you're on the line here. What percentage of companies reach out to you versus companies that you search out or learn about yourselves? And I'll go back to kind of the marketing frame of reference here, right? Which is kind of inbound marketing versus outbound. I think there's, we're fortunate, I guess, to have been doing this now enough years that there's an awareness of us, right? We've got an email list, right? And so like we opened up an application period here in the last several weeks, right? To promote that, right? We push that out to all our, everybody in that list, right? Which includes our investors, which includes our current portfolio founders, which is always a really good way broadly to kind of triangulate to get a conversation with, an investor group. That goes a long way with us, right? Which is someone who we clearly respect and trust and admire, enough to want to work with, says, hey, you should really talk to this person. So getting a referral that way, not just with us, I think with any investor works. So that's kind of on the inbound basis. I think we get a fair amount of that. We have worked pretty, I wouldn't say aggressively, right? But we certainly have the consciousness to know that there's others within our region, and it's important to know those folks, and important to build trusted relationships with those folks about what they're looking at, what they're seeing. And it goes two ways, right? It's what are some interesting investment opportunities maybe that we didn't get directly contacted about, but also if we are going to make an investment and the round needs to be built out, to be able to bring other investors to the table. And so, we don't control their decisioning process, right? It's still on the entrepreneur to close the other funders. But we do our best to kind of have a larger network to be like, hey, we're doing this, which is also the important thing, right? We share actually the things we're investing in. So a lot of times what will happen is people will share stuff that they're passing on, which is, you don't want to be in that zone, right? Because it's like, well, if you're not doing this, why would I? Unless there's a clear thing. We don't invest in, biotech, right? Or some clear delineation around that. So yeah, I think it's a combination. Thanks for the question. Our job, and our customers, right, are our shareholders, which are our investors, pay us essentially to help find really compelling and interesting opportunities. And so we do, again, a blend between inbound and outbound, a lot of referral programs. We try to be present at, I guess it's mostly virtual these days, present at virtual events, right, trying to put ourselves up on in a position where people see us and they kind of get a feel for what we're all about. And this goes back to Julie's point in terms of the type of investors you want, right? I mean, we sort of pride ourselves on this notion that we are very serious about what we do, but we really don't take ourselves too seriously. And I think, if that's what you're looking for, that's us, right? If you want like super intense, right, all the time, and you're never going to smile at you, then that's your choice as well.
Robert, you're making me think just kind of the levels of interaction. So we do have sources where like we've both been in the Pacific Northwest a long time. So attorneys, other entrepreneurs, other investors, people that we know through business, people that we've raised money from will often call us. Like we had an opportunity in Seattle recently, because we have a reputation for being easy to work with, to come in on a potential opportunity that was really, really great. But the other thing that we've really tried to do is have this open application process where entrepreneurs can self-select into that. And that's the criterion that Robert is talking about. And part of the reason that when I originally founded the fund back in the day, we had this process was to have it be more inclusive. So you didn't have to do the usual, a guy to know a guy to know a guy. So I often get these requests in email to, can we do a coffee meeting or can we do a Zoom meeting? And we have right now we have an open application process. So you don't actually have to do some special, spell to get access to us. If you are in the zone where you qualify for that criteria, then you can apply. And if you have some revenue and you have some track record and you have some momentum, you get a call with us. And Robert, how many hours or how many calls have we done this year? I use the term we loosely.
No, yeah, I have to go back like that, 300 or so. And so that's not just like getting a deck via email and thumbing through it, right? That's actually an in-person interaction. It's something, we prioritize that. The stage that we invest at, and there's a question here kind of around the right time to seek capital. I mean, we invest at the seed stage, and definitionally there'll be a lot of shade on, or a lot of different variants on this. But it's a lot of, it's about the person or the team. It's about what are you going to do when this gets really hard, because it's going to get hard, especially as you try to move from seed, which is a little bit of signal of something going on, right, to kind of getting to a mainline business that has some repeatability in it, right? Odds are you're not quite at figured everything out yet, which is okay, given the stage we invest in, because we're conscious about that, right? And we kind of know about that. So I don't remember, Julie, exactly the question you asked me, but that's what I wanted to say.
Yeah, that was good. That was close to being relevant.
Because what I was looking at was Justin's question here. Is there a typical point a business gets to where it's the right time to seek investment? And where my brain was going on that is what, again, if any of you ever talk to us, we try to like lay it out, right? It's like, look, there are 3 boxes that we want to have checked. If we are a regional investor, so we are going to invest in the Pacific Northwest, right? Odds are, if you've got presence in the Pacific Northwest, that's interesting to us as well. But like Germany, it's not going to be something we'll do, right? So that fails the first filter. Invest in software and technology and consumer brands and consumer products, but we're really heavily lean towards direct to consumer, right? So those are 2 more criteria that we're going to take a look at. And then we're going to begin to look at stage. And again, we invest in seed, which means sometimes pre-seed, sometimes a little more advanced, but generally it's in the first external capital that you're raising. The price of the company, which is the valuation you're putting on it relative to our check size. And so we're trying to write a $250,000 initial check out of this fund. And that's us trying to buy 3 to 5% of your company, right? Because that's how our model works. And how we're going to make money for the people that have trusted us, right, to invest in us. So that's going to say that your valuation is going to have to be somewhere between 3 and 7 million on a pre-money basis. Not if you're more expensive than that, does that mean you're bad, right? It just means you're either more advanced than we would buy in at, or maybe you're a little bit out of market. That happens sometimes, but you just have a disagreement, right? So valuation at this stage is kind of an interesting thing to kind of get at. So those are our lenses, right? So I think it's back to that's what a fund would do. And I think it's important for you to know that, back to pre-qualification of who you're talking to, but also for yourself, each of these boxes, right? Can you build the thing you think you can build, right? Is an incremental step in value of the business. You have a product. Does anybody care? Which means you've gotten it, as you've all heard me say, away from your friends and family and the people that don't want to hurt your feelings, people are going to tell you the truth. And if you begin to get signal on that data and usage and recurring usage and upload, I mean, whatever the metrics are, right? Those are really interesting signals. And then the third thing is, anybody care enough to pay, which is just a matter of, that's what you're doing this for, right? You have a business model, so do your best to kind of validate that. And so all those criteria line up, and those three things line up, right? Then we're going to take a hard look, right, at what's going on. So that's us as a fund, right? You as an entrepreneur, the more you click those boxes, the higher value you have sort of created for your company. So the higher price you're going to be able to demand when you raise money.
Yeah, and so I was an infamous bootstrapper when I started my first two companies, and I think the other piece of this is understanding why you need to raise money, what it is for, and the implications of it, right? Because if you take on external investment, then what you're doing is you're promising to return money to those investors. And so we're big fans of when you think that you need to do this, actually creating a pro forma and a plan that says, why do you need the money and what do you need it? What do you plan to spend it on? So, in terms of how much you raise, when you raise it, it's like, when do you need it? Because one of the biggest reasons that companies fail is undercapitalization in the early stages. But it is the most expensive money that you will ever take on because the company hasn't been de-risked. And so early stage investors want the valuation and the terms of the deal to reflect that they're taking on that we're taking on a fair amount of risk at the beginning. Where we most often see companies raising money in the seed arena is when there's some good momentum. They've had some friends and family money, and now they're getting ready to raise a series seed or a note, and they're raising somewhere between $500,000 and $2 million. And often, I think we've said this a couple of times, but often we're the first money in, and so we can sometimes be the first investors to ask hard questions and dig into your paperwork more completely than your early stage investors did, because they loved you and they just wanted you to succeed. We love you and we just want you to succeed, but we also have a responsibility to our investors and to our institutional investors to really dig in and make sure that the legal aspects and the financial aspects of the companies are as buttoned up as possible, and there are no reputational risks and things like that. So sometimes we ask some hard questions, but part of the reason that we do that is because if you are successful and you take on money from a fund like ours, if you go to a Series A, those questions will get even harder. And so we're trying to help companies set up for success. A big value that Robert and I have as lifetime entrepreneurs is to basically help other entrepreneurs. And this goes to another question that's out there, like, beyond the money, what else do we do, Robert?
It's a very good question. No, I think, Julie, this is your phrase, right? That we're active but not activist investors. So when we work together, we are asking for things like information rights, which just means you're going to give us access to the performance of the company over the life of the investment, something we're responsible for reporting to our investors. We generally will ask for like a board observer seat, which gives us a little more sort of formal role, but not so formal that the board of directors gets very mucked up at the seed stage. And again, if anybody's talked to me, you need to be very methodical about your board of directors. You need one, but you need to be methodical about who is on that and what investors get access to that, because it's much harder to remove a board director than it is, even if everything's happy and everybody's fine, right? It's still a mechanical thing. It's a legal, it's a governance thing. So anyway, so that's one shade of it. As I saw that question, I was reminded of last night. Actually, I was on the phone and argue if this is value added or not. So clearly, there's a lot of sort of critical thinking going on around the role of office space going forward. Commercial office leases, if anybody here has ever signed one, are very hard to get out of. are and will trail with you as a company. And so we were, one of the portfolio companies is working to kind of essentially renegotiate its lease, right? It's kind of a sublease thing, blah, blah, blah. Now I am not a commercial lease expert by any stretch of the imagination. But what Julie and I do is we do spend a lot of time thinking about negotiation and thinking about how you create a win for both parties, right? I mean, again, this is kind of our mindset. It's not I win, you lose. It's like, how does success come together here? And I think that as someone who is not sort of kind of directly emotionally attached to the situation and not really mired in the details, we have this ability to kind of parse it, which is what's going on here. It's like, okay, here's the long-term obligation of this. This is what the buyout's going to cost here. There's this. I mean, and it's like, okay, well, let's think about what that party is really interested in. Well, that party that's the landlord doesn't want to not get rent, right? Or whatever it may be. And so I think that is that's a very in the weeds example, right? But that call took place last night at 6:00. It was not scheduled. It was not planned. It was not intended. And it was not a formal request for help. It was, man, I just need some help thinking about this. And I think that's being present, right? And that's being concerned. And I also think the frame of reference of living through some of this stuff. I mean, this is back in the .com era, right? I was at a company and we signed this really gnarly long-term Class A commercial lease, and it was horrible, right? So things like that. I don't know, Julie, you've probably got some better examples.
And the way that we couch it is, you will know best what to do, but here's some musing. So it's like fuel and clarity. I talked to a founder yesterday it's a post-revenue company, but they have an opportunity to potentially be involved in an accelerator that has investment associated with it. And so there's trade-offs, right? If you spend time in an accelerator, you're not spending time necessarily directly on the business. How does that work? And so I just put together a list of questions for her to potentially answer. There's another thing too, which I love about our fund, is we have a distribution list for the founders, and they have a Slack channel, and they also meet on the first Monday of every month and share best practices. So there's a cohort and a community in the fund, in Cascade Seed Fund One, that is,
and we're not on those calls. Nor do we want to be, right?
and so there's a lot of, they're all kind of in similar stages, and so there's a lot of similar problems that they're all facing. And the other thing we've done is we have a list of resources where we've gone out and negotiated some discounts. So there's always all this stuff that you have to think about when you're starting up a business that just takes so much time, and we didn't want every portfolio company to have to go out and start from scratch on searching for payroll service or something like that. So we've been able to negotiate some discounts, that not endorsements of the companies, but just companies that we've heard of that, if it's a good fit, some things.
Yeah, and that was and just to build on that, right? That was looking at the portfolio and looking at their financials and looking at their expenses and saying to her, can we help? Right? Can I reduce the cost of your payroll provider by 10% by going to payroll provider X and saying, can you give me a deal where you reduce the subscription cost, right, or whatever it is? And those programs are out there, and Milena, who's on our team, has done an awesome job of really trying to programatize that. So it's not like, it literally is like when we finalize an investment, we're like, hey, here's a set of things, right? We know these are probably relevant to what you're looking at. Maybe not all of them, go and save a few $100 here or there, because that's what it's going to take to win, right? In the long term. And if we can task us out to sort of go attack those things, and it may seem mundane and irrelevant, but it's totally something we can do. It stays out of your way.
Yeah. And there's a question out there about have we ever met an entrepreneur that we just had to help, even if they weren't seeking money? And so this is part of this application thing. We've had people who got in touch with us who maybe weren't fundable or even interested in funding, but they needed a connection or something like that. And we do a fair amount of that. Part of what's happened is the fund has gotten bigger. We've had to just really focus in on kind of our core process, which is one of the reasons we do these office hours, because a lot of the questions that we get over the course of a month are similar from a lot of different companies. And so we thought this would be a good forum for people to see different people's perspectives as well. How are we doing on the questions?
I think we're doing pretty good. I'm looking at this one, back to the one that you just talked about. If you met an entrepreneur or heard of a business that you had to support or help, what I like to sort of always is when we do a lot of phone calls, right, as Julie said, in terms of trying to really kind of get it. And they're not sort of like, walk me through your deck. It's let's talk, right? Because I always think about this as opportunity cost, right? You're working on this versus doing something else, right? And the answer to that question really drives interest. Again, back to all our filters and things we do, right? The qualification criteria we have. But I think that is, if it's well, I thought being a startup would be cool and blah. Okay, well, that's one level of, you're deciding, right? You're using your time and your effort and your energy and your resources to do that, versus, we live this problem. This is a big problem. All the solutions out there to it suck. And I am going to do whatever I can to solve this, right? And that's why I'm doing this. I mean, those are kind of two ends of the spectrum, right? And to me, the sort of opportunity cost question, I think is a really important one, because again, it's back to like, this is going to get hard, right? Even it never gets easier, right? I mean, you can get momentum, but then things will become increasingly complex, right? Or whatever it may be. But it's like, okay, so there's this whole trajectory of, if it gets really hard, right, how are you going to dig down deep to keep going? Right. And if it's like just something novel that you thought you would do because you had a break in your career and you wanted to do a startup, right? The lure of going back and getting a job or going back to your job is higher, right? Then, man, this I will not rest until this gets solved, right? And I think that's what we're looking for, right? Is I can't rest until this is solved.
Yeah, it's an interesting question. Like, I was just listening to a podcast this morning where this guy was saying, yeah, I was successful in startups, but when I got done with the third one or whatever, I was 50 pounds overweight. I didn't have a relationship with my family, and my mental health was a little strung out. And this is a consideration, right? Because traditionally startups have been, kind of all in like that, and a lot of founders have challenges around their personal health because they don't tend to it, because they focus on growing the businesses. So this is I originally became an entrepreneur because I was an artist and a misfit, and I couldn't really fit in corporate America. So it was kind of like, this is going to be my path, right? I happened to have a talent in sales, and so that was a lot of my career. But it is, we ask this question of the entrepreneurs, like, what would make you quit? And we did have one entrepreneur say he would never quit, and then just before we were ready to make an investment, he quit.
Right.
So because things changed, and so we try to do that.
Yeah. So yeah, right. I mean, that's sometimes things line up for the right reasons. So here's a question on what does good early revenue look like? Depends, blah blah blah. So good question, and I think that the lens that we put on this is, and I've driven a lot of conversations this way, like what does $1 million in revenue look like, right? And then what flushes out of that, or what sorts out of that, is the costs of the business, cost of customer acquisition, cost of support, cost of product, all those things, as well as the revenue drivers, which is, well, I'm going to get money from services and setup and subscriptions, or is it going to be transaction fees, or it's going to be whatever. So there's like that first break point, because you got your pro forma and there's all whatever, and God, I don't want to go and figure out, like, why are you spending $17 in year 4 on, and it's like, come on. But I think you think about that first million as the threshold, right? So get there, and that's net revenue, depending on your business model. That's not, I've executed $12 trillion of transactions across my platform, right? It's like, what's driving your business? And then think to 5, and then think to 10. And then you can extrapolate kind of from there, right? Because sometimes you can begin to get revenue, but it may not be the model that takes you to the 5 and 10 threshold, right? Do what you got to do to get your business going, right? To bootstrap it, to generate revenue. Be careful about if you're going to claim you have a bunch of revenue, but it's not directly related at all to what you're trying to build. Had a recent conversation around, I was confused. I was like, well, we got all this, but you're telling me this. And, oh, that was what we had to do out of the gate. I'm like, well, that needs to be that's an achievement, but that's not a validation of the model, right? Yeah. Because what I'm looking at is like, how is this going to kind of move and scale? And, just kind of inside baseball, what we're trying to do is we're trying to build outcome scenarios, right? So as a fund, and we raise money and we tell people that, we're going to make these investments, we're going to do these things, but our goal is to return to our investors, right? More money in the box back. And so we want to model out essentially, right? It's not super sophisticated, but we're looking at like exit trajectories. Can this thing get to a $50 million sale? Can this thing get to a $500 million sale, right? I mean, the probabilities of those we get, right? But I think there's a discipline in looking at that, and there's absolutely nothing wrong with building a business that's going to generate, a livelihood for you and for your family, and could potentially somebody could buy it for $6-7 million at some point in time, 8-9 years out, or that, but that doesn't fit equity capital, right? What equity capital is going to do, what our investment's going to do, or any outside investor is going to do, it builds an expectation of compressing time and growth. Right. And so those marks of 1 and 5 and 10, like we don't want to have that happen in year 20. Right. It has to happen sooner. Right. We're not looking for the obnoxious hockey stick. Right. But there's a balance here between, how you think the business can grow. Right. And our expectation on how it can grow to try to get to a point where we can kind of get those exit values.
Yeah, those are all great points, because it turns out that getting to that first million can be really hard. And so having an idea of what it takes is huge. So it's like, what are you laughing?
I'm laughing at the question just came in, which is a great one. Why do you do it? I can imagine there's a lot of stress and worry that comes from thinking about the money that others give you to invest on their behalf. On the subject of quitting, do you ever feel like this is stressful? Dee, that's awesome. Here's my take on this, and Julie, I know you've got a lot of thoughts as well. Like investing at this stage and with a fund this size is important work that we want to do. Right, our goal is not to build a big fund and pay ourselves an extraordinary amount of money, because what happens is you begin to lose touch with this phase of entrepreneurship. And quite frankly, this is the one I thrive on and I love, and there's a lot of unknowns. And, I think that there's also kind of this personal and professional vendetta, at least from my end, right? Which is the thing, I learned more about what I did wrong than the things I did right. And I think that there's an ability to help sort of telegraph that a little bit. Sample size of one and a pool of experiences now that are certainly a little bit in the rearview mirror. But raising money was silly. I didn't enjoy it. I wasn't any good at it. Right. I missed the boat on all these things of who to sell to and what to ask and what the process was, and the term that you get into this and the terms. Right. It's like these are things you've never thought of. Right. Or you have to build competency in. I just think at this stage of my career, right, this is a place I can apply my energy and my time and my effort to try to make the biggest dent, right, in the universe. How's that?
I like that. I think you are making a dent in the universe, because you're bringing all your practiced powers and things that you've learned to the table.
So why do you do it, Julie?
Really seriously, I'm very interested in accelerating innovation, creativity, problem solving, economic well-being, and this isn't my first rodeo, and at this phase of my career, I wanted to do something that was meaningful on multiple levels, right? So making money is really interesting and fun, but just by nature of what we're doing, there's an impact in the community through, in the Pacific Northwest community, through money moving through, more money moving through more quickly, more ideas moving through more quickly. We have a very diverse portfolio of leaders, so building additional leadership capacity in the Pacific Northwest that's going to reinvest and start other companies or do other things that are positive. So, for me, it's a way to create a better future, and it's interesting work. I like working with Robert, and I like working with the portfolio CEOs a lot, and just being in touch with kind of the leading edge of relevant developments in business, because we have these 4 kind of key themes that we're investing on, and they're all interesting and important in terms of having diversity in the business community, as well as solving interesting problems.
Yeah. Well, and the other thing is that we believe that this is a great business opportunity, right? We think a small, regionally focused fund investing at our stage with the check size we invest at, with the process we use, which is very structured, right? In terms of optimizing on our decisions, which is not just Julie and myself. We eventually make decisions on investments, but we leverage our investment committee, which is people that are investors in our fund that have a wide swath of experience, that we can actually make better decisions so that we get more success, right? And all that, again, that's back to kind of the return on investment, which is why you do this. And so I think it's really hard, if we had $1 billion fund, the thought of that kind of frightens me, but I don't know that, then all of a sudden it's like, well, I can only invest in companies that I think are going to have $1 billion outcomes. And, look, the majority of acquisitions happen in the $30 to $50 million range. We believe absolutely that, quote, secondary markets, secondary cities are places to build businesses, like Bend and Eugene and Spokane and Boise. And it doesn't have to be Seattle and Portland, which others would say you can't build businesses there. It's got to be in the Bay Area, right? I mean, I think that especially given everything that's going on in the world, and you've got this now more distributed workforce because of everything that's going on.
Well,
it's a really bullish investment.
Oh, sorry. No, my internet connection's a little bit iffy, so you just froze, and I thought you stopped talking. So yeah.
That's for debates, not for our office hours.
I want to underscore that a couple of things you said, which are, a lot of times VCs have very, very intense expectations as far as return, and we like to optimize return. But as Robert said, most of the activity is in that $30 to $50 million range. So as a small fund, we don't have to chase the unicorns, right? We can invest in company that will have great growth, solid returns, do interesting things with with great leadership. So that's our thesis, right? That's core to our thesis, and we think that fits this market really, really well.
Yeah, absolutely. There's a good one. How worried are you, or should a founder be, about discussing their idea or plans with you or others about the plans being stolen? Yeah, so this is
great question.
Yeah, this is a good question. It comes up all the time. Actually, in the recent weeks here, we're talking to a company, we really like them, and so we began to get into diligence. And as Julie said, right, we're very thorough. And it was sort of like, well, should we sign an NDA for this? And so that wasn't, it's a good contextual question, right? So there's multiple levels of that. How enforceable is an NDA anyway? Let's take that off the table. But we're working on our own stuff, right? No, we're not going to take your idea and run with it. And broadly in the arc of sharing versus holding close, like the smartest people are already working on so many other things. They're not going to do your thing because they're going to do their thing. Right. I think where this begins to get a little gray is when, here's a large company that has a similar product or aspirations of a similar product and wants to have a lot of very detailed conversations. Right. So kind of have your general information. This is what we're doing. This is how we're doing. This is whatever it is. Right. But like, if you're going to get into like architecture software, if you're going to get into architecture or core functionality, right, if they want a trial account, something like that, I mean, protect yourself enough on there. At the end of the day, right, if someone does something they shouldn't do, then you have to pursue it. But I think that broadly sharing, right, and this goes back to kind of box 2, which is, does anybody care other than your friends and your family? And you've got to go out and get some time in the live environment where people are going to blow up all the assumptions that you have. So yeah, so like I said, there's especially in enterprise software, right? There really aren't new problems, right? It's just different iterations of the same ones, either based on evolution of technology or behavioral change of companies. So the how unique you're doing it, I think, can be an element, right? But I wouldn't not share because you think someone's going to take your thing, unless it's someone who has the capacity to do so. How's that?
I think that's well said. There's always some risk in there.
So clarification here is a similar company. Yeah. So yeah, I would just I think there's spending time as a software product manager in startups anyway, right? When you begin to deal with large companies and you're looking for the partnership, which you think is going to accelerate your go to market, and they're leaning in because they like what you do, and maybe it tucks into their stack somewhere. Just ask them if this is on their product roadmap and when. Like if it's in the next 6 months, they're already building it, right? If it's in the next 6 to 12, like they're resourcing to it. If it's 12 plus, then you got to figure out what that is. Are they doing a build versus buy decision? Buy meaning license versus acquire. I mean, it may be awkward to ask that. I mean, you may get some silence on the other end of the line or the other Zoom, but I think it's the right way to approach it, because then you'll clarify what you're doing. Like, what are you doing? Like, do you think you're going to get a reseller deal? Okay, well, in that case, they've got to not want to build it themselves, and they've got to look at external opportunities. And that's going to be where this sits in terms of the relative priority.
The other thing you might consider doing, if it seems really tricky and it's something that has potentially high value to you, is to seek out other entrepreneurs that have gone through this to find out what they've done. And this is also where having good counsel can help, because you might be able to have a very brief conversation with an attorney that can help you navigate that.
The most expensive attorney is a cheap attorney.
Yeah, we are big believers in having strong partnerships with an attorney, a CPA, and other professional service providers, because when you're a small, like when we present, like we're a 3-person team, right? Well, myself and Milena, and we actually have a slide that shows all of our professional services providers, because there's like a cast of hundreds behind us that are helping us run the business, and making sure you have good relationships there is really important.
Yeah. All right. These have been awesome questions. Keep them coming. We will continue to banter about a little bit here. We're got about 10 minutes or so left on the time. Yeah, I think these are awesome questions. Hopefully these are worthwhile as well, right? Again, this is just, we started these things when the world, went into the hibernation here back in March, as a way to sort of try to do something. At the time, the world didn't need another Zoom meeting. And we try to do these things. I think we were doing them weekly. We did like 6 weeks just to sort of try to give our perspective on things. And I think at the time it was like, holy crap, we don't know. Like, just buckle down and survive, right? For Q2. Try to seek some stability for Q3, Q4, and then maybe a mindset of a return to growth in Q1. What's been interesting is we got 2 universes we're operating in here, right? Things are super strange. Like, my kids aren't back in school. But what's happened in a matter of now months, I guess, but in a couple of weeks, right? Digital transformation occurred. And so we've seen a massive acceleration in direct-to-consumer brands. The portfolio has been a beneficiary a little bit of this kind of catalytic change that's gone on, not just from brands, but also in software, because now you have distributed workforces, and like all these things around automation of certain workflows, I think has really accelerated. And so, we are certainly, like, I don't know how this still pans out. I don't know how much of it is, government stimulus that's come in to help things, but cautious optimism, I think, as we lean into Q1, but I still would be pretty mindful. No one asked this question, but I'm just offering it. Pretty mindful, right, as we sail through Q4 here.
Yeah, I mean, there's a lot of, it's kind of interesting. So there's a lot of uncertainty, and I think uncertainty always exists, but it's emphasized right now. With the upcoming election, with the pandemic, with the amount of unemployment. things are constrained in a certain way. I think entrepreneurs can get really itchy about that. But we have seen so many interesting opportunities and companies in the last 6 months to a year that are coming through that are doing really, really well. And it's also true that traditionally in times of upheaval, there are a lot of new business starts. Mm-hmm. And the entrepreneurial starts are at a 40-year low. The high percentage of them are being started by women, people of color, veterans, immigrants. There's a lot of talent that gets locked up in large organizations that can get released during times of economic change. So we're interested just to see and kind of ride this wave and be thoughtful about our investment strategy. We haven't slowed down and we haven't sped up. We've just gone at a pace that seems like a really consistent, persistent pace to find entrepreneurs who have that right combination of humility and tenacity and persistence, and also have created a product or approach that looks like it could scale.
Yeah, well said. I mean, we are kind of, even though we're pretty close to each other in physical location, we've always kind of been virtual-ish, right? Even though we've had, a place to go and an office and whatever. And so, we've now made several investments where we have not met the person in person.
Yeah.
And you'll see, I don't know if you follow it or not, but there's a lot of lamentation out in VC land of, oh my God, how are we going to do deals if we can't sit down and look at the person? And, I think that's the transformation that's going on and potentially in the venture industry, right? Is that all of a sudden people have to realize, again, I think that there's a bigger pressure on that. Like if you're going to write a $5 million check, at the Series B, that there's a whole different level here. But we feel we can get what we need, right, in terms of all the mechanics that we're looking through in terms of diligence, and then really dialing in on the relationship aspect. Although we would certainly prefer to sit down and have a cup of coffee or a beverage of your choice, right, to really get at what drives somebody. But we feel we can get at that, using this kind of interface. All right.
Somebody said, speaking of the election, how do you think the election will impact the investment landscape? Give me a couple weeks and I'll tell you. I just think it, change makes change, and we don't, there are people that are looking at macro trends, that are experts in that are financial advisors, and
who are bullish, right? I mean, you can go read your research report of the day, but I really thought when this started happening in March, right? Now having the privilege or the curse of understanding what happened in 2008 with the financial crisis, what happened in 2001 with the dot-com crisis, like I thought we were going over the edge again, right? Yeah. And there was going to be this very slow whatever was going to happen to sort of try to get us back to where we were. And I think the difference between those two times and now, I mean, things were pretty healthy, right? There wasn't, banks weren't overextended. There wasn't a tremendous real estate bubble. I mean, rates have stayed low. And so everyone's kind of chasing better yield and better performance. And I think that's driven a lot of money into alternative assets, which is what we do in private equity and venture capital. So, rates are certainly not going to go up in the near term. I mean, they may inch up depending on how things come. And I'm not an economist. This goes back to opinions. I think that those are things that are outside of our control, right? And we're sort of focused on the things that are inside our control. And, we're going to continue to do those. But like I said, I'm pleased that we didn't have as much trauma when this came to pass as we saw in previous, kind of cataclysmic events.
And the stimulus money was released earlier this time than it was in the last downturn, and I think that was probably
that PPP program. I mean, again, we can beat our government up all we want, but that was well timed, quickly delivered. I know it was a crap show in a lot of ways to kind of get it out there, but it was a pretty significant undertaking that I really think helped. Because especially in our portfolio, right? The first thing you're going to do, 70+% of your burn is headcount. And if you're trying to preserve cash, you're going to let people go. It sucks, right? We've had to do it. It sucks. And what that averted was this massive, right amount of layoffs, even though the unemployment rate spiked considerably. It put enough of a backstop in place, I think, that kept things, relatively stable.
And again, these are opinions, not financial advice, because we're not financial advisors. We are venture investors.
Right. We weren't economists or really informed about any of this, but as you can see, I do have an opinion.
One thing I did want to mention too, in addition to these conversations every month or every so often, Robert and I both are on Twitter, and we have Cascade Seed Fund on Twitter, where we send out articles of interest and post about things that we're thinking about, events that are coming up, stuff like that. So I'm just Julie Harrelson on Twitter, and Robert is Robert CPs.
Ours is the company handle, or the fund handle is at Cascade Fund.
At Cascade Fund.
Yeah, it's not a link to the Twitter thing, but that'll help you find it. Yeah, and I'm is again a personal account, and so represents my personal opinions. And I'll type yours in there. Billy, you can do that as well. Are you typing yours right now?
I'm doing it, yeah.
Okay. All right. So we've got a few minutes left here.
Definitely personal opinions. Yeah. The other thing I want to mention in terms in the context of the elections too is just not to forget that we are in the middle of a global pandemic, and I think how that goes in terms of additional surges, in terms of vaccines, in terms of things having to potentially close down more, I would really like to see. I would really like to see those graphs going down rather than up as they are right now. I know I was watching the news last night, and Ireland has gone back down on a more full lockdown. There's lots of interesting experimentation going on, but the longer that grinds on, I think the more impact it will have. And so, people have many different views about this. I think our view, and we're doing this as a company, is we're not doing any public in-person events until at least Q1 of next year, and we'll reevaluate at that time. And I'm imagining, given on the trends what's happening now, that we'll probably continue that for some time. So and one of my litmus tests for it, this is just me personally, is when kids can safely go back to school. I think then we're on the right track. So thank you all for being with us. We welcome your feedback in the comments section, good, bad, ugly. We want to know if this was useful. It was an hour of time.
It's hard to hurt our feelings, so please try.
Sometimes my feelings get hurt, but
we will do another one of these in November. I think that's the plan.
Yep.
Again, we do these not to hear ourselves banter. We've picked the Crowdcast platform because it seems relatively easy to use and helpful. So we're always tinkering with stuff as well. But appreciate everybody making the time. Great questions. Hopefully some amount of value, and wish everybody a great rest of the day and week and all those things.
Yep. Have a great week ahead. Take care. Be safe.
Thanks, everyone.